The TSX just smashed through a brand new record high of 28,433 points. That's up nearly 23% from last year. But here's what most investors are missing. While everyone's celebrating the rally, there are incredible value opportunities hiding in plain sight, and momentum stocks that are just getting started. I'm about to show you exactly which 10 Canadian stocks you need to know about right now. What's up, everyone? I'm back with a weekly Canadian market breakdown, and this has been an absolutely incredible week for TSX investors. If you're new here, I'm your host, Ali, and I'm bringing you educational stock analysis focused on Canadian markets. So make sure to subscribe and hit that bell icon because we drop fresh content almost every day. Now, this week's market action tells us a fascinating story. While the TSX hit record highs, we're seeing a clear divergence between beaten down value plays and surging momentum names. The smart money is positioning for both scenarios, and today I'm going to show you exactly how to do the same. Let's start with the big picture. This week, the S&P TSX Composite gained 0.33% to close at the record high of 28,433. And here's what's driving this move. First, Canadian bank earnings have been absolutely crushing expectations. RBC just reported Q3 profits of $5.4 billion. That's up 20% year over year. Their adjusted earnings per share came at $3.84 versus analyst predictions of just $3.32. RBC stock jumped over 5% on the news, and it's now the largest component of the TSX index. But here's the key insight. This isn't just about one quarter. We're seeing three major macro forces at play. Number one, the Bank of Canada has cut rates from 4.75% to 2.75% over the past year. And markets are pricing in at least two more 25 basis point cuts before year end. This is huge for interest-sensitive sectors like banks, REITs, and utilities. Number two, we're seeing sector rotation. Materials are up 30% year to date. Consumer discretionary is up nearly 15%. The banks are up over 10%. Meanwhile, traditional defensive plays like consumer staples are lagging. Number three, and this is critical, we have ongoing trade uncertainty with the US President Trump. That has threatened 35% tariffs on non-USMCA compliant goods, which is creating both risks and opportunities depending on which sector you're in. Now, let's dive into our first list, the top 5 value opportunities trading near their 52-week lows with strong fundamentals. Stock number 1, Nutrien, and the ticker is NTR. They're currently trading around $84 compared to its 52-week low of $60.74. Here's why this is compelling. Nutrien is trading at just 14 times forward earnings. That's incredibly cheap for the world's largest crop nutrient company. They're generating over $5.4 billion in revenue. They have strong free cash flows. They offer a 3.6% dividend yield. Plus, management just announced they're hitting their $200 million cost savings target a full year early. With global crop inventories below average and China consuming fertilizers at record levels, the fundamentals are turning. Stock number 2, BCE, ticker BCE. Trading near $30 versus its 52-week low of $28.73, BCE is yielding an attractive 5.8% dividend with $6.01 billion annual revenue. Yes, telecom has been out of favor, but that's exactly why the value is there. With 5G infrastructure investments paying off and a stable subscriber base, this is a classic value play in a defensive sector. Stock number 3, Northland Power, ticker NPI. Currently around $21, down from its 52-week low of $16.14. This renewable energy play offers a 5.6% yield and has a growing offshore wind pipeline. With governments pushing green energy initiatives, NPI's $651 million in revenue and strong development pipeline position it well for the energy transition. Stock number 4, Docebo, ticker DCBO. This cloud-based learning management system provider is trading about 70% off its all-time high. They're generating $54.2 million in subscription revenue with 13% year-over-year growth. The SaaS model provides recurring revenue, and corporate training is only growing post-pandemic. Stock number 5, SSR Mining, ticker SSRM. They're trading near 52-week lows despite having a top-tier balance sheet and consistent free cash flow generation. With gold prices remaining elevated and their diversified mining operation, this represents a quality play in the precious metal space. Now let's flip the script and look at our top 5 momentum plays that are showing serious strength. Stock number 1, Shopify, ticker SHOP, SHOP. The undisputed momentum king. Shopify just reported incredible Q2 results with 31% revenue growth and 16% free cash flow margins. That's 8 consecutive quarters of double-digit free cash flow margins. The stock surged over 21% in a single day after earnings, and it's now Canada's most valuable public traded company, trading around $140, down from recent highs of around $155, but the growth story is intact. Stock number 2, Canada Goose, ticker GOOS, up 17.49% this week alone. Better than expected retail sales and strong brand momentum in international markets are driving this luxury play. The stock had been beaten down before, but consumer discretionary is making a comeback. Stock number 3, Sigma Lithium, ticker SGML, gaining 13.67% as lithium prices stabilize and their spodumene production capacity expansion moves forward. With the EV transition still in early innings, battery material plays are getting renewed attention. Stock number 4, Fortuna Silver Mines, ticker FVI, up over 10% as silver prices surge and their Q2 EBITDA came in strong. Precious metals are catching momentum as investors hedge against ongoing certainty. Next, we have Canadian Natural Resources and other energy names like CNQ, Suncor, and Imperial Oil. They all gained between 1 to 3% this week on higher oil prices. Energy represents about 16% of the TSX. And with oil around $64 per barrel, these integrated plays are generating significant cash flow. Before we wrap up, let's talk about the key risks every Canadian investor needs to monitor. Risk number 1, trade tensions. The ongoing Canada-US tariff uncertainty is the biggest near-term risk. Any escalation could hit export-dependent sectors hard, while domestic focus plays might outperform. Risk number 2, interest rate path. While the BOC, or the Bank of Canada, is expected to cut rates further, if inflation proves tricky, that could change quickly. Watch the September 17th rate announcement closely. Risk number 3, yield curve dynamics. The 10-year and the 30-year yields are staying elevated even as short-term rates fall. We're talking about bonds here. This suggests the bond market isn't fully buying the soft landing narrative. Here's my strategy takeaway. This is a market where both value and momentum can work, but you need to be tactical. The value plays I mentioned offer downside protection with dividend yields, while momentum names give you exposure to the sectors that are actually working. All right, that's your complete breakdown of this week's Canada markets action. Which of these 10 stocks are you most interested in? Drop a comment below and let me know your thoughts. If you found this analysis helpful, smash the like button. It really helps the YouTube algorithm show this content to more Canadian investors. And if you haven't already, make sure to subscribe and hit the bell icon because I drop fresh market analysis almost every week. Coming up next week, I'll be diving deep into Canadian bank earnings season as we get results from TD, BMO, and other Big Six banks. Plus, I'll be analyzing the impact of any Bank of Canada policy changes on dividend stocks and REITs. Remember, this is educational content only, not personalized financial advice. Always do your own research and consider your risk tolerance before making any investment decisions. I'm your host. This has been StockScope Live. I'll see you in the next one. And remember, stay curious, stay educated, and keep building wealth through smart Canadian investing.